So let's talk about the different types of interest, and I'm sure I would hope everybody knows what interest is. It's basically a fee that you charge to borrow money. You borrow money, you got to pay interest, right? The person loaning you the money has a right to make money when they loan it out. But anyway, y'all, there are different types of interest, especially when it comes to financing for the purchase of a home or purchase of real estate. And so, y'all, we'll just take a real quick look at some of the different types of interest. Y'all, first of all, you have discount points, which we know that's just interest that's paid in advance. We've talked about that a few times. Just make sure you remember how much a discount point costs. 1%. Y'all, each point is 1% of the loan amount, not the purchase price. If you get that wrong, you're going to get the question wrong, I promise you. So discount point cost 1% of the loan amount, and then each point will lower your rate by 1/8 of 1%. But then there's this interest paid in arrears. And let me kind of explain it this way. Let's say today is June the 17th. And I'm closing today. In fact, I've closed today, June the 17th. When will my first payment be due? And hopefully you said August the 1st. Now, the reason we have to make it August 1st is, there has to be a minimum of 30 days from the date of closing until the first payment can be due. So even though we're closing on June 17th, July 1st, which would be the first of the next month, that would not be 30 days. So we have to kick it to the next month, which would be August the 1st. Okay? Now, why does that matter? Well, because when you make that payment on August 1st and additional payments each month, the interest portion of that payment, at least for the one you made on August the 1st, included in that payment is the interest you owed from July 1st through the end of July. That's what they call interest paid in arrears. Because every time you make a payment, the interest portion that you're paying is for the previous 30 days. It's not for the upcoming 30 days. It's for the previous 30 days. So, we call that interest paid in arrears. Okay, now, so we know that's the interest paid in arrears, but what about interest that you owe from the date of closing, in this example, say June the 17th, through the end of June? What kind of interest is that? Well, that's called interim interest. Now, when do you pay interim interest? When do you have to pay that? At closing. That will be part of the buyer's closing cost. That will have to be paid at closing. Now, this is going to be on the exam. Now, they could ask you a question about any of these types of interest, but this, you're going to have to know how to do some math, the interim interest. Because, if you think about it, you're going to have to provide this information to the buyer anyway, or should be able to, okay? You need to be able to do what we call a net sheet for both the buyer and the seller. And this is something you'll need to practice on a little bit when you get out there and start practicing, or actually before you start practicing. You need to know how to do a net sheet. Well, so what does that mean? Well, if I'm representing a buyer, they need to know if you make this offer, whatever the offer is, and assuming the seller accepts it, buyer, here's what you're going to have to bring to closing, how much money you're going to have to bring. You do a net sheet, do the math to figure out, because there are many different costs. Interim interest is just one of several different costs that make up all the closing costs for closing. say for example, you do the math, you work up the net sheet, and it says buyer's going to have to bring $5,000 to closing. And the buyer says, well, no, wait a minute, now, I don't have $5,000. Okay, well then do you think we ought to make this offer? No. You can't you can't just be making offers until we know what kind of impact this is going to have on your buyer. And can they do it? Because the last thing you want to do is get the buyer under contract to do something they cannot do. You're going to have all kind of problems then. So you got to be able to do a net sheet. To figure up all the different costs associated with this particular transaction. And I will tell you, not two will be the same. There are a lot of variables that go into every single real estate transaction. So you can't just say it's always going to be between $4,000 and $5,000 every close. No, I'm telling you right now, that's not going to be true. But anyway, one of the costs associated with closing is going to be interim interest. You need to be able to determine that. And it's not hard at all. We're fixing to go over it. But all you have to do, well, first of all, before we get into that, if you look at this second bullet on the slide here, this is in your book as well. But you need to pay attention to the question, because they will likely tell you again in the question to calculate this interest based on a 360-day year, or they may tell you to use a 365-day year. Now, why does that matter, and what does that mean? Well, if they tell you to use a 360-day year, then you must assume there are 30 days in every month. Now, we know in reality that's not true, but that's why I'm saying we must assume. So you base your math on the assumption there is 30 days in every month. That's what 360 days means. Now, if they tell you to use a 365-day year, now you have to know exactly how many days are in each month. So if you're not sure how many days are in each month, you might want to get your calendars out and study that a little bit. Okay? Now, it's my belief on the state exam, they're going to most likely tell you or require you to do this math based on a 360-day year. Again, it's certainly in my market. I can't testify to what it is maybe in your market or what state you're in. But I'm telling you, most attorneys or even title companies, if you use a title company, they're going to use a 360-day year, just because it's easier math. It just makes life easier. So here in this video and in the class, we're going to base everything on 360 days. All right. But you need to know what each are, just in case they do tell you to use a 365-day year. Now, so using 360 days, we know we're going to base this on a 30-day month. Every month. 30 days. And then we got to figure out how much interest we owe from the date of closing through the end of the month. Now, keep in mind, you always have to count the day of closing. So make sure you do that. Are you borrowed the money today? You owe interest today. All right. So let's look at an example of how this would work. Again, we're using a 360-day year, and really there's only about three things you need to know. You need to know the loan amount, which in this example we're using is going to be $200,000 loan. You need to know the interest rate. In this example, again, we're using 7%. And then, again, now on this example here, we're closing on June the 12th. Okay? So first thing you have to do is calculate what is the annual interest that you're going to have to pay on this loan. And you do this just by multiplying the loan amount by the interest rate. $200,000 times 7% obviously is $14,000. Y'all, that's how much interest you're going to have to pay each year. Okay, that's what you owe in interest every year. Y'all, and again, remember, the interest is not even going towards paying off the loan. Y'all, you're going to have to pay this, y'all, as a cost to borrow the money. Okay? So anyway, now once we know what the annual interest rate is, y'all, now we have to break this down into how much would it be per day. Well, how many days are in a year? Remember, we're using a 360-day year. Y'all don't mess this up. So you take the annual interest, $14,000, divided by the 360-day year, and apparently that comes up to $38.89 per day. Now, one thing I will just make you aware of right here, y'all, again, pay attention to the test question. Y'all, they may tell you, I don't know if they will or not, but they may tell you, y'all, when you're trying to determine what the daily interest is, y'all, they may tell you to round that interest up to the nearest dollar, or just round to the nearest dollar. Y'all, sometimes they might say round it up to the nearest dollar. Sometimes they'll say round it to 2 decimal places. Y'all, just make sure you do what it tells you to do in the question. But typically, I think they'll tell you to round it to 2 decimal places, and in this case, it would be $38.89. Well, now we know how much it's going to cost per day. Well, then how many days are there from June the 12th, that's when we're closing, to the end of the month? And y'all, most people, it seems like when I'm doing a live class, they say that's 18 days. You didn't count the day of closing. Y'all, how many days are there from the 12th, the day of closing, to the 30th? And again, y'all, we have to assume every month has 30 days. So if it's February, and you're thinking, well, there's only 28 days in February, and you base it on that, you're going to be wrong, because y'all, you have to assume 30 days in every month. So anyway, y'all, so from the 12th to the 30th, counting the day of closing, y'all, that would be 19 days. So you take the 19 days times the daily interest, $38.89, and we come up with the interim interest of $738.91. Okay? Well, y'all, just for example, why this is also important, y'all, even if the buyer is getting 100% financing, y'all, that means there's no down payment, right? It does not mean you're not going to need money to close. Y'all, please don't let buyers get confused there. Y'all, for whatever reason, buyers are, I'm telling you, if you don't tell them this, you're going to have a problem. Buyers are thinking, especially when they're using some kind of 100% financing, they're thinking they will not need to bring money to closing. Y'all, you're going to have to bring money to closing. And this is one of the costs right here. So we know at a minimum you're going to need $738.91. And I will tell you, there are other costs that will be involved as well that does not take into account down payment. Now, if you've got a down payment, y'all, for example, you get an FHA loan, then you got to put 3.5% down. Y'all, whatever 3.5% of $200,000 is, that's a down payment plus these other costs, right? So, y'all, don't let your buyer be disillusioned here thinking because I'm getting 100% financing, I don't need any money to close. Y'all, this is why you better do a net sheet and figure out what all the costs are, and so that the buyer knows how much money they're going to need to go to closing with. Okay. So y'all, hopefully that helps you out on the interim interest. Y'all, you will have to do some of this on the exam. I'm just telling you, it's not hard, as you can see here, and y'all, there's examples in your book as well. All right, so we're going to move on. Y'all, other types of interest would be, y'all, you got fixed rate interest. Y'all, obviously that means your interest rate is fixed for the life of the loan, which I would think would be the most common. That's what most people would prefer to get. But there are some situations where the adjustable rate mortgage, or this ARM, might be a better idea, especially if it's a very short-term loan. You don't expect to be here more than 3 or 4, maybe 5 years, but I'm thinking about 3 years. If you know you're not going to be in this property or own the property or have this loan for more than 3 years, then the adjustable rate mortgage might be the better way to go. Because we know the interest rate with an ARM is going to be lower. The initial rate anyway is going to be lower than what you would pay if you got a fixed rate. And that lower rate will stay fixed, but for a period of time. Like 3 years, 5 years, again, depending on what the loan requires. So you better know what that maturity date is. But when that maturity date comes, say it's 5 years, at the end of that 5 years, now your interest rate will begin to adjust, meaning it could start going up. Potentially it could go down. But it's going to start to adjust to whatever the market rates are at that time. And typically, I'm just telling you, it's going to go up, and so will your payment. I'm telling you, just a small uptick in your interest, that's going to create a pretty large uptick in your payment that you have to make every month too. So this could be a risky loan, but if it's going to be short term, then I think you'd be okay with that. But then here, the last thing it talks about is annual percentage rate. I want to talk. We need to talk about this for a minute, because this is what kind of baffles me a little bit. If you go talk to a lender, whether you go to their office or you call them or whatever, what's typically the first thing that borrower wants to know about the loan? If I get a loan from here, what's the first question they want to know? I almost gave you the answer, but the first thing out of the buyer's mouth, what's the interest rate? Would you be shocked if I told you who cares? That's not what matters. And here's why I would highly recommend don't even ask that question. And here's why I say that. Now, I'm about to say some things that are going to sound kind of critical, because it is, concerning the lending profession. Now, obviously, look, in any to include real estate, but in any profession, you got some good ones that are doing good things in that industry, and you got some that shouldn't be doing business in there at all. You got some bad ones in there. And I will tell you, lenders are no different. And this is why I said in an earlier, or at least at some point earlier, I think you need to know your lender. You need to know, you need to know them. Not just be familiar, acquainted, or somebody introduced you. You need to know them. And as a real estate agent, you need to get, if you don't already know somebody, when I say know somebody, you know them well enough that you can trust them. They're going to do the right thing for you and your potential clients. Because I'm telling you, you can get taken advantage of in a hurry when you're borrowing money. And you think you got a jam up loan and you've been taken to you've been robbed. I see it all the time, and it just really annoys me that lenders are able to get away with some of the things that they do. When I say lenders, primarily it's the loan officer. Okay, but anyway, you go in there and the first question you ask is, what's the interest rate? I know the lender's not going to come right out and say it, but in their brain, they're thinking, okay, all right, got another one. Ain't got a clue. First of all, is it possible, are interest rates negotiable? Yeah, in some degree, yeah, they are negotiable. Now, there are some things that you got to understand about it, and which we're not going to get into all that, but here's why let me just ask it this way. Y'all, let's say you go to lender A, and they said, we'll loan you this money at 7% interest. And then you go to lender B, y'all, because you're comparing here, which is a good idea. I think you should do that. And lender B says, we will loan you the money at 7.5% interest. Y'all, and we're talking about the same type of loan. Y'all, we're comparing apples to apples here, okay? But one lender is going to charge 7%. The other one says they'll charge 7.5%. Well, y'all, is it possible that you can go with the higher interest, y'all get the loan at 7.5%, and that be the cheaper loan? Yes, in fact, more than likely, that's going to be the cheaper loan. But again, these loan officers know what most buyers are concerned about the interest rate. Y'all, they're going to make their decision on who they're going to go with based on the interest rate. So, y'all, they'll try to make that interest rate, whatever they need to make it to get you to get the loan from them. And they have taken you to the bank. But you're leaving that closing all happy. Oh, I got such an interest rate. Yeah, but they robbed you and you didn't even know it. How does this happen? Y'all, this is what you need to understand. Lenders will charge all kinds of fees. There are fees other than, now interest is just one of the many different fees lenders can charge and will charge, y'all, to borrow the money. It's just the only fee that anybody ever wants to know about or talk about is the interest rate. Y'all, there are many other fees associated with this loan. You need to be more interested in the other fees, not the interest rate. You need to know what are all these other fees. That's what you need to know about. But they never bring it up because they're not required to tell you about it. Now it will be in what we call the loan estimate. Y'all, we're going to be talking about that here in a minute. The problem is most people don't know what they're looking at or what it means. They have no idea. But what I do know is I got a good interest rate. All righty. Make sure you get to where you know how to read that loan estimate. Because here's what you may find out. Y'all, there's something called this last thing here on this slide, again, it's in your book, called the annual percentage rate. Y'all, that's what you need to know. Not the interest rate. What's the annual percentage rate? So what is this? Well, y'all, this is a rate where basically, y'all, it's a number expressed as a percentage. But basically, they have to take all your expenses, y'all, to include the interest rate or the interest. Remember, interest is just one of many expenses or fees associated with the loan. So if you add up what all the fees are, and then whatever that fee is, or whatever the total amount of fees would be, you would divide that by the loan amount, and that will obviously give you a percentage. Y'all, that's what we call the annual percentage rate. So, y'all, let's say, for example, y'all, your interest rate was, with lender A, they said was 7%. But if you look at that APR, which that's the number that tells you the total cost of the loan, y'all, say that was 8.25%. And I will tell you, the APR will always be at least the same as the interest rate, but typically more. Y'all, because obviously interest rate is part of the cost. So if the interest rate is 7%, then you know the APR is going to have to be at least 7%, but we also have to take into account all the other fees. So with the interest rate and all the other fees, y'all, now you're looking at, say, 8.25% per year. Y'all, 8.25% of the loan amount per year. Y'all, that's what it's going to cost you to borrow the money, right? But if you decided to go with lender B, which had an interest rate of 7.5%, but if you paid attention to what the annual percentage rate is for that loan, it might just be 7.75%. Hello? Y'all, would you rather pay 7.75% per year on this loan or 8.25%? Well, then guess what? Well, I assume you said the 7.75%. Then you're going to have to pay the 7.5% interest. Y'all, I hope that makes sense. But y'all, I pray that people will just learn. Don't worry about the interest rate. Okay. Now, obviously, the interest rate is going to be a big part of the cost of the loan, but that's just one part of it. In fact, I always tell y'all, I'm kind of out of the borrowing money phase of my life now. I'm ready to sit down and rest more. But I will tell you, when I do borrow money, and certainly when I have borrowed money, I tell the lender right up front. Obviously, interest rate's not even. I don't even care. I don't even ask about it. Don't even discuss. It doesn't matter to me. What I care about is the APR. That's what I want to know. And so I tell them right up front, I do not want to pay any fees other than interest. I know you're going to charge me interest, but I don't want to pay all these, what we refer to as junk fees. I'm not paying that stuff. And every single time, the lender said, well, you're not going to be very happy with your interest rate. I said, I don't care about the interest rate. I don't care. I care about the APR. That's all I care about. So I would rather pay more in interest and none of the junk fees, or get rid of as many as I possibly can. And then I'll shop it around and see which lender can do the better job at that. But here's why that matters to me. First of all, I might have a higher interest rate than you, but my loan's going to be cheaper than yours, because I got a lot lower APR than what you might have, right? But the main reason I do it this way, the interest, I'll get that back. Even though I'm paying more in interest, I'll get that back. That's a tax deductible item. So at least come income tax time, I can deduct that for tax purposes. At least we can today anyway. If you're paying all these other fees, that's just money down the drain. You ain't getting that back. That's gone. So if I got to pay for something, whether I want to or not, if I got to pay for something, I at least want to be able to use it as a deduction or something that's going to help me out down the road come tax time. Anyway, I didn't mean to spend that much time talking about it, but this is a critical part to me in representation. Now, again, you got to be very careful how you explain this and talk to buyers. Should you ever go tell the buyer, you need to use this lender, you need to take that loan? No. But again, because we can't give that kind of advice. We got to stay in our lane. However, I'm always, first of all, I have to communicate. The real estate has to communicate with the lender. Obviously, whatever lender the buyer chooses. And because, there's information I need to get from the lender to know how to write up the offer on whatever house they want to buy. So, this is stuff you should have ahead of actually making any offers, okay? I got to know what the buyer's qualified for, what the lender would be willing to do, what they're not willing to do. So one of the things I need from that lender, one is the loan estimate. And when I'm looking, and again, I'm not looking at the interest rate. I'm looking at the APR. And in my mind, I say, all right, well, you got a pretty cheap interest rate. But I'm just telling you, if there's much difference at all between the interest rate and the APR, you're getting robbed. That's how you know. Now look, interest rates and stuff, they're going to fluctuate. They're going to go up, they're going to come down. But how you know whether the lender is taking care of you and treating you fairly and honestly, y'all compare whatever they're charging in interest to what the APR is. There should not be a big difference between the interest rate and the APR. If the APR is way up here and the interest rate's down here, Y'all, that means they have loaded you down with junk fees. They're robbing you. Y'all, and I know I'm getting kind of passionate and I'm going to shut up and move on. But y'all, I just hate to see people taken advantage of. And these lenders are taking advantage of some people. Now look, there are some good ones. And this is why I say you need to know who they are. Because they'll actually try to get the loan that, y'all, they know how to make it affordable and in your best interest. But y'all, the higher these fees are, the more that loan officer makes typically. So y'all, they would rather load you down with all these fees, and you're not paying attention to that because look at this interest rate I got you. You ain't gonna get a better rate than that anywhere. Yep, I've heard that so many times I want to puke. All right, so that's your annual percentage rate. All right, I'm done with that. Moving on. We've talked a little bit about these mortgage theories already, but we'll hit it real quick again, because there's basically two different theories, and depending on the state you're in, will determine which theory you have to operate under. And you need to know this for test purposes. Again, we get into the state-specific portion of this course. Whatever state you're in, will address which theory your state deals with. But some states deal with lien theory. Some states deal with title, or I say deal with, operate under lien theory. Some operate under title theory. The difference is this. If it's a lien theory state, that just means title does not pass as security at closing. Paraphrased, if I can say it in simpler terms, the buyer will get and keep title to the property at closing. So in a state that operates under lien theory, when you close, the borrower or the buyer will receive title to the property at closing. Now, if you're in a title theory state, that's going to be just the opposite. Title does pass as security, meaning the lender will get title to the property at closing, meaning, borrower, you're going to have to pay off the full amount of the loan before you can ever get title to the property. So if you don't pay off the loan, you're not going to get title to the property. In lien theory states, you get title to the property when you close. And this is why, if the lender ever has to foreclose, again, depending on the theory that we're operating on, if it's a lien theory state, the lender basically has to file at least 2 lawsuits. One, they got to file a lawsuit to get title, because the lender can't do anything with that property unless they have title to it. They got to have title to the property. So they will have to file a lawsuit to get the title to the property. And then once they get the title, then they got to file another lawsuit to foreclose, force you out, get rid of it so they can sell the property. But in a title theory state, they've already got the title. So now all they got to do is just foreclose. So again, depends on the state you live in. But just make sure you know the difference between lien theory and title theory. And these are the typical common instruments or documents that are used at closing, again, as part of the loan anyway. And you see 3 things listed here, but I will tell you 99% of the time it's only 2 of these 3. And the 2 that you do tend to see at every closing is something called the promissory note and then the mortgage. Now, these are 2 completely different documents. The promissory note, that's the loan. In fact, we kind of touched on this a little bit earlier as well. But the promissory note, that's the loan. By signing the promissory note, you're promising to pay back the money they're loaning you under the terms agreed to in this note. But this does make the borrower personally liable for the debt. But is it possible that people will sign the promissory note, take the money and then not pay it back, y'all, for whatever reason. Y'all, maybe they lost their job, whatever. Maybe they can't pay it back, but at any rate, they don't pay it back. Y'all, is that possible? Y'all, it happens. Well, just in case that does happen, y'all, the lender will also require you to sign a mortgage. Now remember, what did we say the mortgage was? Y'all, that's the lien. Y'all, that's the security for the debt. Y'all, so basically by signing the mortgage, you're agreeing to put that property up as collateral. Y'all, that gives the lender the right to come back and take the property from you if you don't make these payments. Y'all, I don't want to get it. I'm not going to cover this in detail again, but again, just as a review. Y'all remember I said you've got to know the difference between mortgagee and mortgagor. Y'all, the OR and EE. OR gives, EE receives. Well, y'all, who's giving the mortgage? Y'all, I hope by now you're saying the borrower. But y'all, if you're thinking the mortgage is the loan, then you're going to be wrong, right? Because I hear people, well, no, it's the lender that's giving the loan to the borrower. Okay, well, we're not talking about the loan. Remember, the loan is what? The promissory note. We're talking about the mortgage. The mortgage is not the loan. That's security. That's the lien for the loan. So who's agreeing to give the mortgage to the other party? Y'all, the borrower signing and giving the mortgage to the lender. And we know the OR is the one that's doing the giving. So who's the mortgagor? The borrower. The lender is the mortgagee. Y'all, please don't confuse mortgage with the loan. They're not the same. And y'all, it gets confusing because you hear people talking about this stuff all the time. Well, I need to go get a mortgage to buy this house. Okay, well, you're not getting a mortgage. You're getting a loan. We never say anything. We never correct anything. And quite frankly, we might not know that there's a difference between the two. But there's a difference between the mortgage and a loan. Okay, so just y'all beware of that. But y'all, those are the two documents that you'll see used at close that the buyer or borrower will have to sign at closing. Rarely, but occasionally, y'all, this third document might be needed. Y'all call it a deed of trust. Y'all, deed of trust is used when basically the borrower or the buyer will not be receiving title, but neither will the lender. Rather, there'll be some third party that will be holding title to the property, y'all, for whatever reason. There could be any number of reasons for doing that. But when you have a third party holding title to the property for some amount of time or for some reason, y'all, that's going to require what we call a deed of trust. Y'all, basically appointing someone as the trustee over this property for some reason, okay? But that's all that is. All right. Now we get into some of the laws associated with lending, and y'all need to be familiar with these. Y'all, nobody likes getting into law or talking about laws, but y'all, you got to know it. But we start out talking about this National Consumer Protection Act. Y'all, another term you hear used a lot, another common term, in fact, probably used more often, is called truth in lending. Y'all, you hear that probably a lot more common than National Consumer Protection Act. Y'all, they're really referring to the same thing, but it's just another name. It's just known as truth in lending. Now, y'all, another type of, y'all, I'll get it in a minute. Y'all, another name they like to use when it comes to truth in lending is Regulation Z. Y'all, let me try to explain something to you here. And I hate it when they try to cause these kind of issues and really there's no point in this, but y'all, they're going to try to confuse you here on the exam, okay? So let me see if I can make this as clear as possible. Y'all, they could ask you one of two questions on the exam, and they might ask you both questions I'm about to address and go over. But I suspect they'll ask you at least one of the two I'm about to tell you about. Y'all, they may ask you, what law does truth in lending fall under? Or what law is truth in lending a part of? Well, y'all, that's the National Consumer Protection Act. Y'all, the word act suggests law, right? So if they're asking you, what law or what act does truth in lending fall under? Y'all, it's the National Consumer Protection Act. That's the answer they're going to be looking for. But another way they could ask the question is, what's another name for truth in lending? And obviously the answer they're going to be looking for there is Regulation Z. The reason this tends or can be a little bit confusing is, y'all, no matter which question they ask or how they ask it, y'all, of the four options you'll have to choose from in that multiple choice question, y'all, the Consumer Protection Act and Regulation Z will both be there as an option. And then we get confused. Well, is that consumer? I thought they were all the same thing. Okay, but they're not asking you that. Again, if the question is, what law is truth in lending part of, or what law does truth in lending fall under? Y'all, if they're asking about what law is associated with truth in lending, y'all, that's the National Consumer Protection Act. Y'all, the word act should be the clue. Y'all, if it's asking you to identify a law, act. Y'all, National Consumer Protection Act. But y'all, they may have one or two other acts of some sort. So y'all, again, don't let it confuse you. But if they're not asking about the law and they're asking you what's another name, and they very well can, what's another name for truth in lending, y'all, then the answer they're going to be looking for there is Regulation Z. Y'all, I don't know why they got to try to make a big deal out of that. I know it sounds a little bit confusing, but hopefully I explained it well enough. All right, but y'all, when it comes to truth in lending, y'all, these are laws and guidelines that lenders must comply with when loaning money, but it only applies to residential home loans. Y'all, remember that. I promise you're going to have to know it. What kind of loans must operate under and comply with truth in lending? Residential loans. Y'all, commercial loans have nothing to do with this. Y'all, they got a whole set of requirements for commercial loans. So truth in lending only deals with home loans. Y'all, just for example, y'all, say a homeowner decides to wants to borrow money to put a pool in their yard. Would that loan fall under truth in lending for a pool? Absolutely. Yeah, well, because that's part of your home. And if you're borrowing money to put a pool in your yard, you're probably getting like an equity line of credit or something like that. But y'all, anything you're doing to your home, on your property, and you're borrowing money, y'all, that's part of your home. Y'all, that would fall under truth in lending. But if you're doing anything commercial, y'all, there's nothing commercial about putting a pool in your yard. But anything commercial, y'all, that will require, y'all, commercial does not fall under truth in lending. Y'all, I'm trying to think ahead, but truth in lending only applies to residential loans. Now, another law we need to understand is this Real Estate Settlement and Procedures Act, or RESPA. You hear it called a lot. Y'all, this law does a number of things, but two things that you really need to be concerned about, and certainly for test purposes. Number one, this law eliminated kickbacks. Y'all, now kickbacks are illegal. Well, what does that mean? What is a kickback? Well, and I will tell you, years ago when I first started in real estate, y'all, this was legal. It's now illegal, what I'm about to tell you. But y'all, I would have lenders, y'all, not long after I got my license, y'all, and I don't even know how lenders knew I got my license, or at the time I didn't. Now I know y'all, lenders will go on the LLR website, y'all, or the Real Estate Commission's website, and y'all, they look for new licensees, people that have just received a real estate license. And I would have these lenders calling me up, y'all, because they saw where I just got my license. They said, and they would call, and all of them, they were pretty much saying the same thing. Mr. Griffin, we wanted to congratulate you on your new career. We know you're going to be very successful. You're going to be very profitable in real estate. And we know that because we're going to help you get there. We're going to help you meet every one of your financial goals. And here's how we're going to do that, Frankie. If you have someone call you or contact you about wanting to buy a house, obviously they're going to need a loan. You send them to me. You give them my number. I'll make sure they get a loan, which means you get a closing, you get a commission, you're getting paid. But not only that, Frankie, but here's what else we're going to do for you. Because you referred them to us, y'all, anybody you send to us for a loan, we're going to send you a check for $500 or $1,000 or whatever the case may be. Y'all, that's what we call a kickback. Y'all, you send me business, I'll give you something in exchange. Y'all, that's a kickback. Well, RESPA has now said that is now illegal. You cannot make referrals to anybody and receive a kickback. Now, first of all, can you make referrals? Y'all, if I have a buyer say, or I ask the buyer, who's your lender? Y'all, because obviously I'm going to have to communicate with them. Well, Frankie, I don't have a lender. I really don't even know anybody, honestly. Do you have somebody you could suggest? Well, yeah, I could give them the name of a lender, somebody I know, somebody I trust. Y'all, I'd be glad to do that. Y'all, and there's nothing wrong with you referring somebody to somebody else, whether it be a lender, to an attorney, to a home inspector. Y'all, making the referral is perfectly fine if they ask you for a referral. Now, you better not be telling them you need to use this person or you have to use that person. Y'all, we hadn't gotten there yet, but y'all, there are other laws that say it's the buyer's right to choose. And if you in any way try to suggest they have to or must use some other person other than somebody they would prefer to use, y'all, that's a no-no. But if they ask you for somebody, y'all, there's nothing wrong with referring them to somebody you know and trust. But you better not get anything in return for that referral. Now, y'all, when we say kickback, y'all, kickback is not just money. It's anything of value. Lunch, no go. Y'all, they can't buy you lunch. Y'all, they cannot give you anything of value in exchange for you referring to them. Y'all, that's what they're talking about, these kickbacks. And by the way, a settlement service provider you see listed here, y'all, that's just anybody providing a service in connection with the transaction. Would be the lender, the attorney, home inspector, y'all, whatever. And then the other thing this law requires is the lender must provide, y'all, we used to call it a good faith estimate. It's now called a loan estimate. And you'll see why and when that name changed here in the next hour. But y'all, this is what I was referring to earlier. Guess what? The number one thing you need to pay attention to on that good faith estimate or loan estimate, the APR. That's what you need to pay attention to.